Hey guys, welcome back to Andrew Invest. Studies have shown that the average retail investor only makes around 2% returns per year. Now that's significantly below if they are just invested in the S&P 500 at 10% or even just below the rate of inflation itself. And this is commonly used as a reason why it's completely pointless to do active investing or investing in individual stocks. But why does the average investor make so little? So today I want to go through the top 3 reasons why I think the average investor underperforms, and if you're not making these 3 mistakes, you're already ahead of 95% of the competition. Market timing is the boogeyman of the investing world, but even the greats have done it at some point in their career. Warren Buffett, Bill Ackman, you name it. But they do it far less than the average investor, and that shows in their returns. When you buy a stock of a company, you should be aiming to hold it for years unless the story changes significantly. Not trying to predict the price movements of the company on a daily, weekly, or even monthly basis, buying and selling in and out of the stock. You can't predict the future, and don't believe anyone who tries to tell you otherwise. There's a lot of people out there trying to convince the average investor that it's possible to make a huge amount of money with very little effort and basically predicting the future using patterns and technical trading markers. But it's all a load of BS, or as I like to call it, astrology for men. Just take a look at these clips here.
Job done. Perfect. So we have a beautiful 31,793.32.
How do we know how to play breakaway patterns and these gaps that keep happening on earnings? It's about a 20% drop or something. Now, people get excited about this. I do say that gaps often fill. Gaps always fill.
In the same way with astrology, where they give really vague predictions for what will happen in the future that could be interpreted in any number of ways, which means that people are more likely to believe it, it's the same thing with technical trading. They give really vague predictions for what will happen in the future because ultimately, if you have a line, you don't know whether it's going to go up or down. After it's actually happened, gone up or down, you can say, oh yes, this was the pattern, a double bottom, double top, death cross, whatever. But in the moment, it's impossible to predict which way the line has gone. For example, if you've drawn 2 lines like this, you could say potentially the next line that will be drawn will complete it and make it a triangle. But the reality is that someone could draw the line in a completely different way, or the market could trade in a completely different way, and it will end up being a completely different shape. Now, you might be wondering how these traders are making so much profit on their trades, or how they're affording to buy luxury cars, live a luxury lifestyle, and so on. Well, the truth is that they aren't showing you their non-profitable trades or the trades where they lost an equivalent amount. I guarantee you that if these people had a method that actually made them money, they wouldn't be selling it to you. They'd just be using it themselves to make absolute bank. But the reality is that they sell you their techniques in order to get you to buy their courses, and their courses are actually how they make money. So don't fall for the meme of technical trading. Even if you do it yourself, it's likely that on the long term, you will not succeed, especially when banks have algorithms doing the same things which will outperform you 99.9% of the time. So what should you do instead of market timing? Well, buy and hold good companies for the long term. In the short term, the market is a voting machine, or effectively a popularity contest. It's impossible to predict what companies will come out on top in the short term. But in the long term, the market is a weighing machine, and good companies will always rise to the top of the stock market, as that's the basic function of the capitalist system that we live in. Think less about the price at which you buy a good company's shares, unless it's ridiculously overvalued, and think more about what the good companies are and how long you're going to hold on to them for. In addition to that, ignore the financial media, especially when it's them predicting absolute doom and gloom for the S&P 500, for the US economy, and so on. Ultimately, the news is designed to get clicks and views, not to have your best financial interests in mind. It's very easy to just panic when you see some of the headlines and sell all of your stocks and then miss out on a giant rally that comes only weeks later. Just look at the COVID pandemic headlines and realize that you would have missed out on a huge amount of money if you'd sold when the media told you to. What I would also say about buying and holding good companies is that it's a lot easier during a downturn to not sell them. After all, you've researched their story, you've researched their financials, and they all look good to you. It's a lot easier to hold on to them than if you had just bought them because in the moment you thought the market was going to carry that stock upwards. The second reason why retail investors underperform, in my opinion, is hype stocks. Now, what is a hype stock? Well, a hype stock is a stock that has a lot of buzz generated around it. The media is talking about it, your friend at the pub bought some, and in general, it's just being spoken about everywhere. But when you actually look under the hood at the financials, the company actually hasn't done that much in terms of free cash flow, in terms of profits, but is hopefully expected to do so in the future. I'm talking about companies like Palantir, Tesla, Cloudflare, and so on. And when you get caught in the hype of these types of stocks, it's very easy to overlook and forget about boring or safe companies that have absolutely outperformed, like Apple, Google, and other big tech companies. After all, nobody's talking about them. They're not exciting. Yes, they might outperform in the long term, but I want gains right now. So that's why most retail investors invest into these hype stocks. This ties into the market timing point I made earlier. If you buy into a good company with a track record of raising profits and free cash flow year after year, it's a lot easier to hold onto it in a downturn than if you were to buy a hype stock and the market turns and there's no longer any hype. If everyone else is selling a stock that you bought for hype, it's very easy to sell at a loss as well. Let's compare two different companies, Apple and Cloudflare. If Apple was to go through a downturn, the company has a record of purchasing significant amounts of its share back per year. And if the share price went down, there's almost an insurance mechanism whereby the company will be buying more of its shares back at a cheaper price, therefore giving you more value as a shareholder. Whereas Cloudflare has very little in the way of profits. I think it's had one successful quarter where it's generated profits, which means that it can't buy any of its shares back when it goes down and has to raise more money by selling more shares, which drives the share price down and down in a vicious cycle. That's why it's a much better strategy to buy a good company with a track record of profits. The third reason for underperformance, in my opinion, is value traps. Now, value traps are a lot more insidious than the first two reasons, and they're a lot harder to identify than hype stocks. After all, you can identify a hype stock by checking what everyone else is talking about, and then going and checking the financials of said company. They probably won't be that good. Whereas with a value trap, they can often mimic the type of stock that many value investors want to buy by having very low valuation metrics like PE ratio while still having a decent free cash flow. They might pay out a hefty dividend to attract investors, and in general, they can really fly under the radar. But in the long term, some of these valuations are so low because there is a reason for it, and there's a reason that the company is valued so low by the market, and it leads to massive underperformance in the long term and opportunity cost. Some examples of value traps, in my opinion, are Disney, British American Tobacco, and sadly, even Alibaba. I'm coming around to the idea that it is a value trap, and my purchase of it is probably a bad one. In my opinion, the best way to avoid value traps is to avoid focusing overly much on the valuation metrics of a company. Now, that might be hard as a value investor to hear, but it's just the reality. A company with a very low price to earnings ratio probably has a low price to earnings ratio for a reason. That company might go bankrupt within a few years, the industry might be dying, and the list of reasons goes on. Instead, you want to focus on one, the story of a company, whether it can potentially grow its revenues and profits year on year for decades to come, and whether it has a track record of doing so over the previous decades. Now, Warren Buffett has abandoned his cigar butt method of investing, or investing in companies that have one puff of profits left in them, to invest in compounders, companies that will compound over decades to come. And in my opinion, we should also be following that strategy. So that's, in my opinion, why the average retail investor only makes around 2% returns per year. So if you did agree or disagree with anything I said in this video, please let me know in the comments. Let me know what you think about active versus passive investing. And if you did make it this far in the video, please leave me a like and subscribe, and I'll see you guys next time.